Thinking about selling your house to upgrade? Do the math. You will trade a $2,000 payment for a $3,200 payment for the same size house. The housing market isn't crashed, it's frozen. I am Marcus, this is Macro Finance, and today we're going to explain exactly why millions of American homeowners are trapped in their homes, not because they can't leave, but because the math of leaving has become impossible. It is called the mortgage lock-in effect, and here is the simplest way to understand it. In 2020 and 2021, the Federal Reserve pushed interest rates to zero, and they bought trillions of dollars of mortgage-backed securities. The result? The 30-year mortgage rate fell to 2.65%, the lowest it has ever been in recorded American history. Millions of Americans bought homes. Millions more refinanced. Everyone locked in. Then, in 2022, the Fed raised rates to fight inflation. By October 2023, nearly 8%. Today, 6.43 to 6.66%, down from the peak, but still 2.5 times the pandemic rate. And here is the result. 70% of all existing U.S. mortgages are below 5%. 49.9% are below 4%. Those homeowners are not moving, because why would they? Meet Tom and Lisa, Columbus, Ohio, 2 kids, bought their starter home in 2021 at 2.875%. They want to upgrade. They cannot afford to. Part 1. The real math. Tom and Lisa bought their 1,400 square foot home in Columbus in 2021. $285,000, 20% down, a loan of $228,000. Their rate, 2.875%. Monthly principal and interest, $946. With property taxes and insurance, about $1,400 per month total. Fast forward to today, their home is worth about $340,000. They have 2 kids who need separate rooms. Lisa got a new job 20 minutes away. The 1,400 square feet is not enough anymore. So they look at a 3-bedroom, 2,000 square foot home in the same neighborhood, listed at $379,000. Here's the math at today's rate. 6.5%, 20% down, $75,800. Loan of $303,200. Monthly principal and interest, $1,917. With taxes and insurance on a larger home, about $2,700 to $2,800 per month. They're currently paying $1,400. The new home costs $2,700. That's $1,300 more per month, $15,600 more per year, for a slightly bigger house in the same city down the street. And yes, their home has appreciated. They'd sell for $340,000 and walk away with about $55,000 in equity after costs. To hit a 20% down payment on the new house, they'd have to empty another $20,000 out of their personal savings just to close the gap. And even after draining their savings, it doesn't change the monthly payment. Nothing changes that $1,300 gap. Tom is converting the dining room. They're not moving. Tom and Lisa would spend $1,300 more per month for a slightly bigger house in the same city. That is the golden handcuff. Tom and Lisa are not a special case. They are 70% of the American homeowner market. The Mortgage Bankers Association estimates that the lock-in effect has kept between 1.3 and 1.5 million homes off the market every single year. Think about what that means. That is roughly equivalent to an entire year of new home construction, vanished from available inventory. And the effect on prices? Academic research shows the lock-in effect boosted home prices 5 to 6% above where they otherwise would have been. The median home price in May 2026 is $434,300. That is 57% higher than before the pandemic. And NAR estimates we are 4.7 million homes short of what the market needs. Here is the paradox that makes this especially frustrating. Higher rates are supposed to cool housing markets. That is the textbook economic response.
But when nobody is selling, higher rates just make the few available homes more competitive. Prices held, even climbed in many markets, despite rates that should have caused a cool down. And when will it thaw? Fannie Mae 6.4%, rest of 2026. Mortgage Bankers Association 6.5% through 2026, 2027, and 2028. NAHB, rates will not be consistently below 6% until the end of 2027. There is no path back to 3%, not in the foreseeable future. The market isn't crashed, it's frozen. Sellers won't sell, buyers can't afford, and it stays that way for years. Part 3. The Human Toll. This is not just a market story, it's a life story. Storable surveyed 1,000 U.S. homeowners at the start of 2026. 73% said they would consider moving if they could transfer their current mortgage rate. 31% said they would move immediately. But the numbers that really stopped me: 22% of homeowners said they would delay retirement by 5 or more years to keep their mortgage rate. Not because they haven't saved enough, because they do not want to give up their mortgage. 8% said they would stay in a relationship they want to leave to keep the mortgage rate. 6% said they would skip or delay medical care. These are real people making real sacrifices, growing families cramped in homes too small, empty nesters who want to downsize but can't because their payment would increase, people turning down job offers in other cities because selling means losing the rate. And for renters, it's even darker. 25% of renters say they will probably never be able to afford to buy. 21% have stopped aspiring to own altogether. 22% of homeowners would delay retirement to keep a mortgage rate. That is not a housing story. That is a life being restructured around a loan. Part 4. Who built this trap? In 2020, the Federal Reserve did something unprecedented. To save the economy from the pandemic, they dropped rates to essentially zero, and they bought trillions of dollars of mortgage-backed, directly subsidizing mortgage rates.
The result? A 2.65% 30-year mortgage rate, never seen before or since, and millions of Americans locked in. The more damaging legacy of those low rates is the lock-in effect. Homeowners sitting on 2.5 to 3% mortgages are not selling. That is compressing resale inventory in a way that will take years to unwind. That is a real estate professional, not a conspiracy theorist. The math just works that way. Then, in 2022, the Fed raised rates rapidly to fight 9% inflation. Both decisions, easy money and fast rate hikes, were defensible, but together they created a housing market that is stuck, frozen, between the homeowners with deals too good to give up and the buyers who cannot afford to enter. The Fed pushed rates to 0% to save the economy, then raised them to fight inflation. The housing market paid the price of both decisions. Part 5. Your 5 options right now. You cannot change the Fed. You cannot change mortgage rates, but you have 5 real options, and most people only know 2. Option 1. Stay and wait. Rates may fall to 6% or slightly below in 2027. Every 0.5% drop on a $350,000 loan saves about $100 per month. But waiting has a cost. Your family needs space now. Life does not pause for rates. Option 2. Rent out your current home. Keep your 2.875% mortgage, rent your home to a tenant. Buy or rent your next property. You keep the golden handcuff and get the space you need. The numbers need to work, but for many people, they do. Option 3. Downsize strategically. If your home has appreciated 40 to 60%, selling and buying something smaller at today's rate might actually result in a lower monthly payment. The math sometimes works,
especially for empty nesters. Option 4. HELOC for renovation. Keep your first mortgage at 2.875%. Borrow against your equity at current HELOC rates. Add a bedroom, finish the basement, build the addition. Tom and Lisa converting their garage into a bedroom costs $35,000 to $50,000, a one-time cost, versus $1,300 more per month forever. Option 5. Move anyway, if life demands it. Job relocation, divorce, health reasons, family that cannot wait. A 6.5% mortgage today is not a life sentence. If rates drop, you can refinance. Marry the house, date the rate. It's a cliché because it's sometimes true. None of these are perfect, but knowing the options means you're making a choice, not being trapped by default. The housing market hasn't crashed. Prices haven't collapsed. It's frozen. Tom and Lisa are not moving. Their neighbors aren't either. And 70% of American homeowners are in the same position. The question is not whether the market is good or bad. The question is, what is your situation, and which of those 5 options gives you the best life? Hit like if you've been thinking about moving, but the math stopped you. Subscribe because this system keeps creating traps worth understanding. And comment below, are you locked in? How long have you been thinking about moving? I'm Marcus. This is Macro Finance, and we'll see you in the next trap.